On Friday, gold jumped 7.24% to close at $4,339.20, and silver did something even more dramatic, surging 9.98% to $63.39 in a single session. Those aren't typical daily moves for precious metals. Those are the kind of numbers you see maybe a handful of times a year. But here's what almost nobody explaining this move is telling you. The biggest driver behind Friday's surge wasn't really about gold or silver at all. It was about a specific category of trading fund that was forced to buy back positions it had bet against the metals, all at once, into a market that had almost no sellers left to absorb it. Tonight, I want to walk you through the real mechanics behind this move, not just the headline number, why this particular kind of rally can be more fragile than it looks, and the honest caveat that even the bank flagging this rally is putting out to its own clients. Stay with me because understanding the plumbing behind Friday's move tells you something the excited headlines won't. Section 1. What actually happened Friday? Let's start with the trigger because it's genuinely worth understanding in sequence. Friday's move was set off by July's non-farm payrolls report, which showed the U.S. economy lost 23,000 jobs against expectations for a gain of roughly 80,000, compounded by a combined 103,000 downward revision to the May and June figures. The dollar index posted its worst weekly performance in roughly 3 months on the news. Precious metals read that combination, a weak dollar and falling rate hike odds, as textbook support, and gold and silver both jumped hard, with gold closing at $4,339.20 and silver at $63.39. But that's only the surface story. The move actually started building days before Friday. Between July 28th and August 5th, silver had already climbed 8.3% on a weakening dollar, driven by a mix of dovish signals from the Federal Reserve, Bank of Japan currency intervention, easing yen pressure, and falling oil prices. According to Goldman Sachs' own futures desk, the primary driver of that initial move wasn't fresh fundamental buying. It was managed money funds building long positions, with open interest rising by $2.4 billion over the week. Then, on August 5th specifically, short-term momentum signals flipped, officially triggering what's called systematic CTA short covering, a mechanical wave of buying from trend-following funds that doesn't care about the underlying story, only about the direction the price just moved. Quick ask before we go further. If understanding the actual mechanics behind a move like this, not just the exciting headline, is useful to you, hit subscribe because we break down what's really driving these swings. And I want to know, did Friday's jump change your read on gold and silver, or are you waiting to see if it holds? Tell me honestly in the comments. I read every one. Now let's get into what a short squeeze actually is because it explains why this move happened as fast and as hard as it did. Section 2. Why this move was so violent. Here's the mechanical explanation because it matters for how you read what happens next. Going into this rally, institutional positioning in silver was about as compressed as it gets. According to CFTC data, as of July 28th, managed money net long positions in silver sat at just the 3rd percentile of their range over the past 2 years, meaning funds were holding some of the lightest bullish positioning they'd had in nearly 2 years. A lot of that money wasn't just neutral, it was actively short, betting on silver falling further. When the dollar started weakening and momentum flipped, those short positions became painful fast, and traders holding them were forced to buy back silver to close out their bets and limit losses. That forced buying adds real upward pressure on top of whatever organic buying is happening, and it can cascade because each round of short covering pushes the price higher, which forces the next round of shorts to cover too. That's why silver's move outpaced gold so significantly, up nearly 10% against gold's roughly 7%. Silver carries a smaller futures market and higher volatility, meaning the same dollar amount of forced buying moves its price further, and analysts have specifically noted that silver has historically led gold in these squeeze dynamics because of that structural difference. TD Securities had flagged 2 specific technical trigger levels ahead of time, a short covering trigger around $4,222 for gold and a relong trigger around $4,300, and both were cleared during Friday's session, which is part of why the move accelerated the way it did rather than drifting higher gradually. Section 3. The caveat even Goldman Sachs is flagging. Here's the part of this story that most excited coverage of Friday's move is leaving out entirely, and it comes directly from the bank whose own trading desk has been tracking this rally closely. Despite the sharp move in futures prices, Goldman Sachs has specifically noted that the physical silver market has shown no corresponding sign of tightening. 3-month silver lease rates, which measure the cost of borrowing physical silver and tend to rise when real-world physical demand is outstripping available supply, actually declined during this price surge. That's a meaningful signal. It suggests this rally has been driven predominantly by speculative capital flowing into futures contracts rather than by any sudden intensification of physical buying or industrial demand. Goldman's own assessment is direct. This move looks more like a positioning-driven squeeze than a fundamentals-driven breakout, at least so far. There's an additional wrinkle worth knowing because it complicates the simple silver deficit is exploding narrative you'll hear elsewhere. The Silver Institute's own February 2026 forecast does confirm a 6th consecutive annual supply deficit for this year, projected around 67 million ounces. But that same forecast projects industrial silver demand actually declining roughly 2% year over year to about 650 million ounces, a 4-year low, driven by reduced silver usage per unit in some electronics and solar applications as manufacturers engineer around higher prices. That's a genuinely important nuance. The structural deficit is real and documented, but it's not currently being driven by accelerating industrial appetite. It's more a function of supply constraints than surging demand this particular year. Goldman has also cautioned that medium-term momentum thresholds, the kind of signals that would confirm a more durable trend shift rather than a short-term squeeze, have not yet been breached. And the bank's FX strategists don't currently expect the dollar weakness that helped trigger this move to be sustained. Section 4. What to actually watch from here. So if Friday's move was substantially mechanical, how do you tell whether it turns into something more durable? The clearest technical signal analysts are watching is whether silver holds above its 20-day moving average, currently around $59.17. A confirmed close above that level on strong volume would be read as a genuine squeeze activation signal, with follow-through in gold toward resistance near $4,115 becoming more probable. On the downside, a confirmed close below gold support around $4,013.80 on real volume would invalidate the current squeeze thesis entirely and open a path back toward the $3,940 to $3,980 range, essentially erasing much of Friday's gain. There's also a practical, unglamorous factor worth knowing if you're watching the futures market specifically rather than spot prices. The August gold contract's first notice date for delivery falls at the end of this month, meaning traders holding long futures positions have to either close them out or roll into the December contract before then. And that roll activity itself can add short-term noise to the price action independent of the broader trend. Put simply, watch whether silver can hold above roughly $59, watch whether Goldman's medium-term momentum thresholds eventually get breached, and don't mistake a short covering rally, however sharp, for confirmation that the physical market has suddenly tightened, because right now the data says it hasn't. Here's what I want you to walk away with. Friday's move, gold up 7.24% to $4,339.20, and silver up 9.98% to $63.39, was real and significant, but it was substantially a mechanical event. Extremely compressed short positioning, meeting a weak jobs report and a falling dollar, triggering systematic CTA short covering that fed on itself. That's different from a move driven by a fresh surge in physical demand or a genuine change in the structural fundamentals. Goldman Sachs' own data shows physical silver lease rates actually declined during this rally, and industrial silver demand is projected to soften this year, not accelerate. None of that means the move isn't meaningful. Positioning extremes and squeezes are a real part of how these markets work. It means the honest read is more nuanced than the market just changed direction forever, and the technical levels ahead, roughly $59 in silver and the $4,013 to $4,115 range in gold, will tell you more about whether this holds than the excitement of Friday's headline number. I want to hear from you. Do you think this move has real legs once the short covering dynamic plays out, or are you watching those technical levels before adjusting your own position? Tell me honestly in the comments. I read every one, and it shapes what we cover next. If breaking down the actual mechanics behind a move like this, not just the exciting headline, was useful to you, subscribe before you go, because we'll be tracking exactly how this plays out.